Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hey Chris, good to see you again.
Hi Lee, good to be here. Hope you had a good Christmas.
Yes, I did. It was really nice. A bit of nice family time. Turkey for dinner, but I think the Vauxhall household, we don't do the traditional turkey roast.
We've moved on from turkey now. Simplified life on Christmas Day, but it's great though. Lasagna, nice glass of red at all as well. A bit of bubbly, but lasagna is our course of the day on Christmas Day.
Straight into the games then with the family, yeah?
Yeah, absolutely.
Less cooking, less cleaning, and straight into the fun.
Less hassle.
So we're going to have a good discussion on 2025. But first of all, we thought we'd look back on 2024 and the Ultimate Stocks portfolio. Close to 20%, I think it returned in 2024.
Yeah, it was good. It was good return. A lot of US stocks in there, but it marginally underperformed the S&P 500. But I've looked back actually over 3 years. So 1 year it was up about just under 20%. The S&P year, as we speak, was up about 25, 26. But over 3 years, the Ultimate Stocks portfolio is marginally outperforming the S&P, up about 31, just under 31, S&P 28.5. It's not bad. We're quite happy with that. But we've got a lot of European stocks in there as well, a lot of UK listed companies. So it's not just US, it's not just tech. We don't hold all of the Magnificent Seven, and clearly all of them have had a fabulous year. So that's good. And some of the European names, LVMH, L'Oreal, pulled down returns. Some of our UK names, one of them in particular, Games Workshop, which has gained entry to the FTSE 100 index, have been a long-term holder in the Ultimate Stocks. That was a great performer, as was Sage. Sage, the accounting software group, performed pretty well. And we've stood our ground with Sage. A lot of people, a lot of well-known investment managers gave up a few years ago with it, but it's been a decent performer. So yeah, we're quite happy with the Ultimate Stocks portfolio. That's our main portfolio. We run the Income Boosters, which is a dividend-focused one, which I think marginally underperformed the FTSE 100, but we've rejigged that a bit. So you got a big yield on that, so circa 7% yield on our Income Boosters model. And we also run our mega trends, which we report on less. I'd say one of the lessons for the Ultimate Stocks was, I think it's interesting, is running positions. We're not hugely active. We have done some changes, but we've run positions. And as a result, the likes of NVIDIA and Microsoft are very high weightings now. So we haven't trimmed them off. We're probably going to do this year. We're going to rejig it a bit. The benefits of running positions, sticking with them, play with the momentum to your favor. Institutional fund managers don't have that luxury because they're restricted. They can't let certain companies become too concentrated, whereas the private investor can. So if they're really comfortable with the stock, they want to stick with it, they can do what they like. They can let the thing dominate their portfolios. And running our positions has served the Ultimate Stocks portfolio really well.
The two stocks that perhaps are stand out in it have been Microsoft and NVIDIA. Do you anticipate that to continue into the new year, or are you looking at the landscape that they operate in and thinking, I wonder if there's changes in 2025?
There will be changes. We've got a few in there that were a little bit on the edge, but those two, they're going to stay in it. If you want to position in AI, it's very important. And those two stocks are the primary AI plays and have been at both ends of the scale. Effectively, one is a massive customer of the other, being Microsoft is a massive customer of NVIDIA. But yeah, if you want to be in the AI space and you want a position in it, and it seems essential, really, then I think it's important to have those two stocks. And Microsoft's been in this thing for a long time now, and it's a great company, and it's reinvented itself over the years, as NVIDIA has as well. That's what this is about, keeping relevant, keep reinventing yourself all the time. And these businesses, these giants have had to do that, and they will continue to do it, hopefully.
So what investment then have you made in 2024 that you now regret, and what did you learn from it?
I think playing the AI play, and it's not an investment that was only made in 2024. It's a smaller company, and it's been around, ever present in our AIM portfolios, in our associated business fundamental AIM portfolios. And probably one company that comes to mind, which has really been at the other end of the AI spectrum, the risk from AI, is RWS Holdings. It's a business involved in patent translation and localization services, and its activities are massively under threat from AI. Probably the regret was not getting out probably earlier. And on many levels, the shares look very cheap. We've continued to add to them, and they got cheaper still. It generates a lot of cash, but the last results were a bit really disappointing on many levels. And it's now is having to play catch up. It's trying to project to the world that it has a relevance even in the AI world. AI can help its translation services. It can help it reduce costs, but it's clearly in a very tough position. And you can just see it's been investing like mad to keep up with things. So we will see how that goes in 2025. There are other aspects. Weirdly, it's a business that reported a staggering loss of money or loss in value of its head office. It bought a head office about 10 years ago, and it's managed to lose 75% of its value in an affluent area in the south of England, which looks very questionable to me. I don't know what's gone on there. And it's had to register a huge impairment in the value of this building. 10 million quid on a 14 million pound valuation. So that's another thing that doesn't sit well. So this business, from being a popular, smaller AIM company, it was a big AIM company, £1 billion AIM company, has now got into the kind of position where who knows where its future lies. Again, though, it's all about reinvention. A lot of these listed companies have reinvented itself. If it foresaw what was coming along, it could have recycled cash into other areas as well. Crikey, a name like RWS can do what it likes.
Yeah, just something that came to me there as well. That's a brilliant sort of articulation of an investment that you kind of look back on and you've learned from. What about the investment that you looked at and thought, should I, shouldn't I? And then now you look back at it and you think, I should have done. Why didn't I?
I wouldn't answer it as one that's got away. It's when to really back yourself when you believe in something.
Yeah,
I think it's important because there's one little company, again, a very small company, that's one of our bonkers bargains. And I thought it looked very cheap many years ago. It was too small for this is our associated business fundamentals holdings.
Yeah.
I've got a personal stake in it. I took a stake and a reasonable stake, but it looked cracking value and management were doing all the right things. A business called Time Finance is really boring. It just does lending to SMEs, asset-backed lending and invoice discounting, just core lending services to SMEs. Look very cheap. Clearly, when the government was chucking out free money, its business wasn't in as much demand as it is now. Now it's a bit tougher for SMEs to borrow. Time Finance is well placed, and it's been doing really well. And I had a good position, but it's one of those things you should have. When you see something as a really good bargain, you should go for it. And you've done a lot of work. You should really make a decent commitment, especially when it's crying out, saying bye to you. And the shares still look decent value, but it's not quite the standout crazy bargain that it was. There was another instance in the pandemic. My business partner and I were discussing recently a business called Jet2, the leisure airline. Their shares absolutely fell like a stone over the pandemic. And we thankfully made a decent investment in. We looked at it and this is crazy. They were trading under their tangible net asset value, I think, at one point. They had loads of cash. They were managing the situation, the pandemic, pretty well. And we did make a commitment then. So I think the really lesson is when you see an outstanding opportunity, go for it, because it won't be there. These things don't come along all the time, and you should really commit to it.
Yeah. So back your convictions.
Yeah, absolutely.
Brilliant. As we look forward to 2025 and the London Stock Exchange and UK economy, could it be the year of reckoning for the London Stock Exchange?
I think it could be. Is it relevant? How relevant it's going to be? We've got news that the thing is, could it do better in the hands of a more interested sort of exchange group? It's owned. The London stock market is owned by the London Stock Exchange Group, but the London Stock Exchange Group makes all its money from data. Is it really interested in capital markets per se, as an exchange? Could it really do better in the hands of another exchange group that's more interested in it in its core activity? We've got this Shein listing that's now been rejected by New York that's coming to London. Well, it's not a great reference. Being rejected by a major global market that's uncomfortable with its corporate governance and its structure. So then come to London. But yeah, that could be a big IPO for London. But yeah, the LSE really needs to up its game. And I think by extension, AIM, the subdivision, London's junior market, I think has a fabulous opportunity as a global small cap market, but it too has to up its game because there've been so many takeovers on AIM and the main market, and they're going to continue. There are so many targets out there on AIM at the moment, businesses trading at modest valuations. They've proven themselves on the junior market. The balance sheets are in great shape. So watch out for the takeovers to continue, all bar the family-controlled ones. And we can see more takeovers unless things improve. And private equity's still got a lot of money. And they're gonna go for it. Recently, there was a roundtable event attended by all the various brokers, stockbrokers to AIM companies, investment managers to AIM companies. The head of AIM was there as well, and it's evident that the changing rules around inheritance tax have really taken their toll. There are fewer flows going into AIM companies, and quite a lot of prospective money coming out, because it's actually more attractive for many people now to consider. This isn't at present, the rules are still very supportive, but by April 2026, when they change, it's probably going to be more attractive for people looking to mitigate IHT to go into private company IHT structures. These have been created by institutional fund managers, but if you go into these private company vehicles, which multifaceted, multi-business structures, you'll benefit from the initial £1 million IHT free. So the first million won't be subject to IHT, whereas that doesn't apply to AIM companies. So that could be a meaningful thing for AIM. And I know many of the AIM participants will be lobbying quite hard there to be a level playing field with that. So for that £1 million not to be offered to these quasi IHT sort of planning structures, or private company IHT planning structures.
Are they lobbying for AIM companies to be included in it, or for it to be either or?
It's a good point. Ideally, yes, to be included in it would be great, but knowing government and Treasury,
that's a bit unlikely.
Are they likely to unwind something like that? I don't think they realise in their wisdom what they did. I think the intention for the £1 million was to protect genuine family-owned companies and farms for that matter. And I don't think they realised there were a lot of these IHT created vehicles that fund management groups have created to mitigate IHT, which are far removed from family companies. They're not established to grow. They're simply established to mitigate IHT and generate very little growth. They're also incredibly fee heavy. The hidden fees in these things are huge. So the fund manager doing very nicely. The owner, the investor, doesn't really generate any growth. Well, you could say they've gone backwards holding AIM shares, but in fairness, so maybe they're not too worried about that. The sole purpose is to mitigate potential inheritance tax on the estate at a future date. So they're not fabulous, and I think it's incredibly generous for them to benefit from this £1 million relief.
Yeah, agreed. Was there any other key topics that were discussed? Maybe how to reinvigorate AIM, really drive interest in it? Was there anything?
I think, there needs to be more coverage of AIM, more coverage of smaller companies. That needs to be opened up a bit, the restrictions lifted, encourage greater research. Clearly, the volumes are down and trading volumes are massively down. So it's not much to pay for the research that was typically paid out of sort of trading comms. Big question, how do you attract nice, fast-growing businesses to the junior market? And that's a tough one when you've got the opposite side. You've got still private equity out there, got a load of money, and a lot of these business owners, entrepreneurs, quite like the thought of life off public markets, a bit quieter, less pressure. You're not answerable to shareholders. Well, you are, but not a disparate bunch of public shareholders. So they quite like life off the market. At some point, there's going to have to be a crystallization event. Private equity will want out when you can pass it on to the next private equity, but sooner or later they might want to come out and venture onto the stock market. And the other issue is the cost of listing. It's stratospheric, really, to list a small business. And if you're a business owner and you've worked hard all your life to grow over the last few years, to grow your little company, and you're told, you can list it on the stock market, it's going to cost you, I don't know, several million quid or whatever it is. You probably think, hold it, why do I want to just throw that away? Our private equity is not going to cost that much. So I think the cost of listing, that's got to be trimmed down. It's got to be rationalized, make it more effective, which hasn't been the case, I think.
Yeah, you mentioned there as well, raise the awareness of it. Certainly, there's a big focus on pension consolidation at the moment, and the lack of interest in people's awareness of pensions and where that money is going, there seems to be an opportunity there, perhaps. So the government certainly seems to be pushing, making people more aware of pensions, where that money's going and how it's being invested. Perhaps
Yeah, I think that people are less aware of what's going on. They see this sum of money mysteriously be deducted from their payslip every month. We go, "Oh, where does it go? I'm not sure where it goes." You have your POE, your national insurance, but then you have this mysterious workplace pension sum that goes into this mysterious pot, and you're told you'll select a fund it goes into, but that's it. Then you forget about it. Then you move job, you get another one of those. 2 years later, you move job and get another one. And so people are going to accumulate these things. So I think there needs to be a consolidation. Oh, and what shocked me, I think they read this correctly. There are 25 or 26,000 separate schemes, direct contribution schemes. Why do you need that many schemes? Why do you need all these managers and pots that are being looked after? God, you just need a few, don't you? It's just ludicrous. You're not adding any value. So the whole system needs to be shrunk, I think.
Yeah. Lots of fees being made off all those pots, would there be?
Oh, of course there are.
Would that
But
be a
what's,
fair
what's the
comment?
point? Somebody, they see the financial services industry. It knows how to take fees. It
Yeah.
knows how to invent complicated terms. Terminology is fabulous. Create some new products and come out with a whiz-bang title for it, and nobody has a clue what's going on, but it sounds good, doesn't it? Wow, let's attract some money into it, some structured product that is a black box. But yeah, the pension landscape is just going to become horrendous. And some of these schemes are going to develop into absolute monsters. You've got the government scheme alone, Nest. It's got, I think, 11 million members alone, people contributing all the time. That is just going to be huge. And actually, that's a good vehicle. That's the sort of thing we should be having more giant, in my opinion, more giant schemes like that. And there should be, as you say, a greater education and awareness given to everybody where their money's going. That's not simply about being able to look at where it is, but understanding where it's going to. Do you know it's going into companies? Do you want to have a choice of where it's going?
Yeah, I definitely agree. My grand now, she's 83. When she was growing up, the idea was the government would take care of her pension, and now she's 83 and she's getting her state pension. And then when my parents grew up, they grew up in an environment where the corporations were tasked with taking care of their pension, and they've now retired and they've got a company pension. And then my generation been very firmly shifted from the company to my responsibility with the DC vehicles. So when you look at that through the different generations, how the government has said, "Oh, hang on a minute, we need to shift this onto the companies," and the companies have gone, "Oh, hang on a minute, this is now a bit of a burden on us. Let's shift it onto the individual." And then at the end of the day, the individuals, they're not aware that they've got this retirement to pay for.
It's thought by shifting it on that they've passed the
passed
buck,
the
kicked the
buck.
can down the road, but it says somebody else. But in fact, it's going to all come back to haunt them.
It
Because the
will.
individual's pretty clueless, and they don't know that by making extra contributions and the laws of compounding, how much better off they would be. So there are many aspects, and then you can't just impose something like that and not have the educational piece around it. I think it's just crazy.
Yeah.
Because the government knew what it was doing in the first place, or we hope. And then the companies are, as you say, saddled with these vast pension deficits now. They don't want to have anything to do with it, but now it's down at the individual level. You're right.
Went off a bit of a tangent there.
Yeah.
So as we look forward to 2025, what are you looking at for the Ultimate Stocks portfolio? What are you thinking going forward? Are you content with the holdings you've got? You've mentioned you're going to look to trim a few.
Yeah, we're not too sure about a few. We're comfortable with some, but probably if there's a lesson in there, it's probably to be wary as to the ones you're most comfortable with. In terms of 2025, what's it? I hate fortune.
Yeah, but this is not a crystal ball prediction.
Exactly, gazing
this
into the
can end
crystal
really
ball.
badly, couldn't it?
Yeah, so without delving into stock specifics, that we will mention some stocks, but it's the year. We're still immersed in AI, all things AI. It's where there's so much money going into it. And two of those stocks, we've already mentioned them, Microsoft and Nvidia at the both ends of the scale. Nvidia, can it keep this going? Is it the only game in town? There are others. There are other interesting positions that are benefiting from AI. Nvidia has been the poster child of it. Clearly, the growth's going to not continue like quite at this stratospheric level. But at the other end of the scale, the big worry, I think, is how are we going to commercialize this thing? How is it going to start paying for itself? Microsoft is a case in point. It's spending vast amounts of money on it, a lot of it with Nvidia. But how's it going to start charging us? How have we, as the consumer, going to pay up for it all? Previous tech models have been very advertising driven. That seems unlikely with AI. It's not beyond the realms, but it seems there's going to be subscription models more in play with this. And who are they're going to be the long-term winners and who are going to be the losers? Because you've got a business like Microsoft that's gone from low capex to now a big capital spender, because it's spending all this money on AI development. It's not alone. You've got Meta's doing the same, Alphabet maybe to a lesser extent, Amazon's doing the same as well. They're spending vast sums of money, and it's got to pay for itself. You can't keep shoving up buildings without filling them eventually and without working out what the rent's going to be. So 2025, we're going to start to see that, I think. At the end of the year, we'll start to see how the business models are evolving in this space. And it's all around us now. I mean, if you use an accounting package, you're getting AI assistance. If you're creating images, you're getting AI assistance. So you can't ignore it. Everybody said, oh, it's a fad or whatever. That's rubbish. This is here to stay. And it's affecting all our lives, whether you know about it or not. You're doing things, and it's working in the background with many businesses already.
Agreed, 100%. Should we leave it there then, Chris?
Yeah, thank you. Bye. Speak to you soon. Bye.
Well, that's it for today. Please subscribe as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.